Holistiplan presents Tax Time with Jeff Levine. Let's talk taxes. Hi, I'm Roger Pine from Holistiplan. I'm here with Jeff Levine. He is the Chief Planning Officer at Buckingham Strategic Wealth. He's also a member of our team here at Holistiplan as our tax planning strategist. Happy New Year, Jeff. Great to see you.
Good to see you too, sir. Happy New Year to you as well. Ready to get 2022 off and running, huh?
Let's do it. And we're going to talk about something that really elements of what we're going to talk about. Advisors should probably be talking with their clients about like right now. Like this is a plan this out at the beginning of the year thing rather than a think about it in June and start implementing it halfway through the year thing. And we're talking about our charity planning. We've got 3 topics related to charity. And I think a lot of it's going to come back to, again, a conversation that makes sense to have right now with a client before they start writing checks out of wherever, so that we're all on the same page with our clients and where charity's coming from, how we're doing it. So, but before we talk about strategy and stuff like that, I just want to make sure we're up to date on changes to some of the way charity works. There was a couple of experiments coming out of the pandemic that I think are all gone now. Quote unquote above the line or below the above the line deduction, and then you had a new name for it, and then also
below the line deduction,
exactly,
yeah.
And then some monkeying with the AGI limitation. So could you take us through just what is now the state of play as far as charity goes?
Yeah, I think that's one good conversation to have with clients at the start of this year, Roger, is just giving them an update as to where the tax rules stand for charitable contributions or deductions for those charitable contributions. So last year, actually the last few years, we had a deduction available for those who did not itemize. It was a little bit different in its practice between 2020 and 2021. In 2020, it was a true above the line deduction. It reduced AGI. In 2021, it was as we just talked about, a below the line deduction. So still available for non-itemizers, but it did not reduce AGI. That said, it was a deduction available to the overwhelming majority of Americans who take the standard deduction. It's about 90% of all Americans fall into that category now, and many of advisors' clients fit into that group as well. This year, there is none of that. There is no deduction for cash to certain charities, et cetera, for non-itemizers. So for those individuals, they can go back to thinking about if they're going to donate, do they want to donate, appreciated securities as opposed to cash again, where they, if they're not going to get the deduction either way, you might as well give away an asset that is loaded with taxes. We'll talk more about that, I'm sure, in just a moment when we talk about QCDs, but that's one thing to know. Now, for higher earners or for bigger givers, there was some other changes last year that applied as well. For instance, you were able to give a lot more of your income away through a charitable contribution deduction. In fact, you were able to offset all of your income, all of your AGI via a cash contribution to a qualifying charity. Now, that may not have been great tax planning because if you're offsetting all of your income, you're offsetting all of your, let's say, 37% income, your 35% income, but also all of your 12% and 10% income as well. That said, it was allowed for last year. It's no longer allowed, though, for 2022. And even if we see Build Back Better come back, even if Build Back Better is rebuilt, so to speak, it is not expected that any of those changes or any of those provisions would be reinstated for this year. There's no plans, nothing floating around Washington right now. Now, of course, we are seeing a rise in Omicron, as you mentioned. These were linked to pandemic relief to encourage more people with resources to give to charity. So if things get bad or news continues to be negative in terms of the virus spreading again, maybe Congress does something and they bring back these. But right now, clients should operate under the auspices that in 2022, none of those enhanced charitable breaks are available.
Got it. Yeah, and so those AGI limitations, I'll just give one example. I had a client who had a building that they donated to charity rather than try to sell it. They were having trouble selling it. That was actually a planning move. They just could not sell this thing. And so they donated it to charity, and it
but
had
it's worth a lot, right?
Well, in their mind. And so that was a case where that came up. And so that was a planning conversation that happened when they decided that they could get more value out of it as a charitable contribution than as a sale of this asset.
And now someone who wants to do that could go back to giving away property as opposed to giving cash, right? Because in order to get those enhanced charitable deductions for the past few years, you needed to do cash. So some folks who wanted those larger deductions were giving in that fashion. Now you can go back if you're looking for, a quote unquote regular charitable contribution deduction. You can go back to giving away appreciated securities again, or property for that matter.
Right. So you mentioned QCDs, the qualified charitable distribution. And again, we kind of introduced this as, if we're going to do a strategy around charity, like let's do that through the whole year. You may have clients who they're either newly eligible to do a QCD, or it's not a strategy they've done before. But if they already have, especially if they already have RMDs and then some of it they don't need, and they're already giving to charity, that's something they ought to try to hit first, I would imagine. So maybe is there anything about QCDs that advisors maybe don't know about or didn't realize, just how that works mechanically and why we want to really apply those first beyond, say, something on the itemized deduction, for example?
Yeah, absolutely. Well, first off, QCDs are probably the single best way for older individuals, when I say older, 70 and a half or older individuals, to give to charity if they have IRAs. You're giving away entirely pre-tax dollars to a charity. So that is an absolute win. And despite the fact that clients don't receive a deduction for it, they never add that income to their AGI to begin with, which is a win, because not only does it keep what I refer to as the end of the game score low, right, the taxable income, but it keeps the halftime score, AGI, low as well. So things like Medicare premiums, credits that get phased out as AGI increases, surtaxes that get phased in as AGI, all the things that are good that go away in the tax code, or all the things that are bad and come in, almost all of them, very few exceptions, almost all of them key towards that halftime score, AGI.
Social Security taxation also.
Yes, Social Security taxation, another one, sure. Helps, so QCDs help to manage that. Now, in terms of things advisors should know about, well, let's start with, why are we talking about this now? We set this up as a discussion around charitable contributions, to charitable conversations, I should say, to have with clients early in the year. Why, if someone is going to make a QCD in November, for instance, if they want to take money out in November, why do we need to talk about it now in January? And it's because if we don't have those conversations, sometimes clients, not realizing something, may do things that they don't realize could be impactful in another way. For instance, maybe they take their RMD now, and then they say, oh, I'd like to do a QCD with it. Well, you can't once it's out of the account, right? You can't turn around and give that money to charity. Now, the question often comes up down the road, right? I get a lot of these questions in November and December. My client took money out of their IRA already this year to satisfy their RMD, but they want to make a QCD. Can they? The answer is unequivocally yes. Of course you can. If you
up to 100,000, yeah.
Exactly. If you haven't used your $100,000 yet, you can make your QCD, but most people who are in that position, or at least many, want to use the QCD to offset the liability of the RMD. In other words, if they have a $12,000 RMD and they want to give $5,000 to charity, they want to net take $7,000 from their IRA and have the other $5,000 go to charity to offset the RMD amount. Total, that's 12. If that individual took $12,000 early in the year, let's say in January, February, maybe they start taking it monthly, $1,000 a month. And then in November, they come to you and say, we'd like to give $5,000 to charity from our IRA. They can do that, but you can't put the money back into the IRA that was already out. You can't even roll it over back into the IRA, even if within 60 days, because it was an RMD, and RMDs can't be rolled over. So it's kind of like toothpaste, right? Once that RMD has been squeezed out of the IRA, there's not really a great way to stick it back in, and you're stuck with it. So having that discussion early can make sure that clients prioritize using those IRA dollars first to satisfy the QCD, so that you don't overtake unnecessarily from an individual's retirement account.
Yeah, two things I would just mention is, we were talking about itemizing or doing a normal charity and then itemizing versus reducing your AGI through a QCD. And that's a pretty complicated thing to explain to a client. And so that's a great example of what I would used to do. Now I work for a software company where we do this, but side by side, you can show them, show all else equal, and where I've got RMDs, give money through a QCD versus give money and then itemize. And then you'll be able to show them the impact on tax. And it does make an impact on tax. Like that's the best way to explain to a client the actual impact of doing it the QCD wise. It's always going to be better.
Totally. Running a double scenario and scenario
Right.
analysis, right?
Side by
You
side.
tell them, bottom line, you do it this way, we're going to save you $600 of tax this year. And in 2 years, we'll probably save you another, $2,000 of Medicare premiums. That's tangible value. And one thing I love about tax planning, I know we're kind of off a little bit on a tangent here, Roger, but one thing I love about tax planning compared to so many other things that an advisor does is that there's immediate, like tangible value there to a client.
Right.
So we talk about like investing. Look, you gotta do right. You gotta have your diversified portfolio. You gotta pick things in the right way, et cetera. But even if you do everything super amazingly well, outside things can happen that take your decisions and make them look bad. Even if you're down 20% when the market's down 30, you might feel like, wow, I did a great job, but the client is not looking at their portfolio most times saying, oh, good, I'm only down 20%, right? Like they don't feel that value. Or even Social Security. You might plan at 60 years old, do their Social Security plan and say, okay, you're going to delay till 70. And here's what it's going to feel like at 70 that's still a decade away to see the payoff of that decision. This is tangible value that you can show side by side. Here's what we're going to do. Here's what you're going to do without me. Here's what I'm suggesting you do. And today it's going to make a difference. Like this year, it will have a tangible difference in the amount of money you can either keep in your pocket or that you can spend on your loved ones or whatever it may be. So that's my unsolicited pitch on why I love tax planning so much for advisors, not as CPAs, but as advisors. It is so powerful because of that immediate impact.
All right, Jeff, you're starting to sell me on this tax planning idea. We'll see.
Right.
We'll see if I
know what we should do. We should totally figure out a way to put this in a software that advisors can use to show.
It'll never happen. Yeah. There is one practical aspect of the QCDs, coming back to that, which is it can be a bit of a hassle for, $50 to the guy selling candy bars for the Boy Scout troop.
Yep.
I'm not sure if every custodian will do this, and I'll admit I didn't have firsthand experience with this, but I do remember having some clients who would actually get a checkbook from the custodian, and they could write those checks to charity from their IRA account. So we didn't have to go through paperwork every single time. I don't know the limitations on which custodians do or don't allow that. And you have to be careful because those are for charity, but that's just something that from a practical matter, if your client is given monthly or weekly, I do understand that QCDs are harder to do than the big $10,000 chunk sort of thing.
100%. So from a practical perspective, that's a great way to go about it. If your custodian has that, then certainly to use that provision for those 50 or 25 or whatever dollars is. So here's a few suggestions for advisors looking to do that. A, double check, make sure your custodian offers that. More and more custodians do. Many of the very large custodians that I know most advisors custody with right now do offer that checkbook IRA. Sometimes you've got to jump through some hoops to get it, set up for your clients and to allow those type of accounts, but they are available most places. Two things to point out though. One, whereas if the custodian sends out the dollar, you submit paperwork, and I admit for $25 distributions, it's a pain in the neck. So I would be cognizant of this. But if the custodian sends this out, you submit paperwork to the custodian, they send the check out to the charity. Once that check is sent out from the IRA, it's a distribution for that year. So if you're writing late year checks, like Christmas checks, right? It's done. You know that RMD was satisfied. If you use a checkbook IRA, the custodians don't have it as a distribution from the account until that check is cashed. And a lot of people at the end of the year like to take time away from the office, including people who work for charities. And so sometimes that check doesn't get cashed until the next year. Now you have a shortfall in an RMD. You might get relief for it, but it's a pain in the neck. It's, it limits the effectiveness. So if you're going to do that, do those check writing earlier in the year. The other thing to keep in mind is if you're going to do that, make sure clients write checks from the correct account. I had a scenario a few years ago where a client accidentally, not one of my clients, but someone who came to me, tried to figure out how we could undo this, They wrote the check for the down payment of their home, their second home purchase, with their IRA checkbook, as opposed to their regular brokerage account checkbook that they had. They saw their name on top, didn't realize it said IRA, and so that was was a situation where we had to try and undo that. And thankfully, we were able to fix it. But you want to be careful. So actually, one of the things I suggest for advisors is, if you know you have clients who are going to do this, put $10,000-$15,000, whatever that may be, of the client's money that they're thinking about doing this with. Open up another IRA, especially at a lot of your larger custodians where there's no custodial fee. Open that up, put $10,000 in there, make that their account. So if they accidentally write a $30,000 check out of the account, guess what? It bounces. They're actually happy. The check bounces there. So it kind of minimizes the downside if people use the wrong checkbook in those instances.
I love that. Okay, great. Thank you for that. So we've talked about QCDs. The other thing that happens with charity, and again, you don't want to get this half wrong halfway through the year, is for folks who are grouping deductions into 1 year versus another year, sometimes your client loses track of, and sometimes the advisor, you lose track. And so it's good to get on the same page every year as to, is this a standard deduction year or is this an itemized year? And so am I writing checks to charity out of my donor advised fund, or am I writing them directly, and am I contributing to the donor advised fund this year?
Yeah, I mean, that's exactly it, right? If we're looking at from a tax planning perspective, and we're not saying people shouldn't give to charity, we're just saying, what is the optimal way to do this from a tax planning perspective? Because of the relatively high standard deduction that we still have, a lot of people have trouble reaching that amount. They struggle to reach the standard deduction amount. And one way to help overcome that, to see a benefit for some charitable contributions where none might have otherwise been received, is to lump a bunch of years' contributions together into one big contribution. So let's say I give $5,000 to charity every year. Maybe I make $25,000 of charitable contributions this year. And you could make that all up front, and the charity would probably be really happy if you do that, right? They'll be thanking you with open arms, and you can tell them this is for the next 5 years.
Don't call me for 6 years. Yeah.
Right. Don't call me for the next 5 years. But they're not going to do that, right? The second you do that, next month you're getting something that says, hey, we're a little short, we're struggling, can you help us out? And clients are going to feel that pull in their heart. And again, not that we don't want to, not that we're trying to discourage giving to charity, but we're also trying to implement clients' intentions. So one of the ways to satisfy this, I want a big deduction up front, but I want to actually give to, meter it out to the charity over time, is through the donor advised fund. And so more often than not, when we're using these things, you're using those large contributions 1 year. This might be the year where you look and you say, do we have appreciated securities? Those can get gifted into or contributed into the donor advised fund. And then, are you going to then write those checks, or have the custodian send out checks from the donor advised fund to the charities of your choice? Or if this is a year where you're making a large donor advised fund contribution, you can also give directly to the charities in those years, right? You can kind of bunch those together. So instead of putting $25,000 into a donor advised fund and then sending out $5 to a charity, you could just give $5 to the charity outright, put $20 into a donor advised fund. You're kind of in the same position either way. But yeah, knowing what sort of, are you an on year or an off year for giving to charity directly or via one of your other vehicles that you may have. Could even be charitable trusts that are there set up. For the ultra wealthy, there are foundations that sometimes get set up, and depending upon how that foundation is set up, they may or may not have a mandatory distribution that has to get sent out to a charity. So there's lots of things involved, but ultimately, for the majority of our clients, it's simply a matter of, do we want to be bunching contributions this year? And while Build Back Better is kind of on hold for the time being, we also can look at potentially bunching SALT payments together as well, with the idea that maybe it gets expanded if they pass something later this year. Who knows, right? It's unclear where that's going to go. But last year, Build Back Better was going to retro those SALT changes to the beginning of 2021. So I think if they get something passed, if that's still a big if right now, looking at you, Joe Manchin, but if something happens, it will likely be retro to at least the beginning of 2022 based on that earlier concept. So we'll see. Lots to think about, though. As always, good conversations. And look, at the end of the day, Roger, picking up the phone, spending 5 minutes or so with the client to just educate them about, that's the stuff that clients will remember at the end of the day. When things, we're in such an unbelievable market for the past decade or so. When things go sideways, we want to have clients look back on all these other things, the other phone calls, the other conversations we've had, for them to say, look at all the things that my advisor does. And yeah, it's a lousy market right now. And look, I hope that conversation never happens, but chances are it will, right? Like, I mean, if history is any indicator, it will happen sometime. We just don't know when. So kind of filling up that goodwill bucket now with the client while we still can, while times are good, just gives us that much more insurance and solidifies our relationship with the client that they are indeed clients for life. And hopefully their kids and their grandkids become clients for life. And we just perpetuate that cycle and continue to provide that family the best advice that we possibly can.
Yeah, sounds good, man. I did want to, you wrap things up nicely there, but now I feel bad about going back to the Bunchie
I
story,
just put a bow on this, Roger. Come
on. You really
on.
did. Just two things I wanted to highlight. You made a good point about so many times that's talked about as a every other year strategy. And you made a good point that sometimes it's not every other year. Sometimes you take a big bath in 1 year. I had a client, there was 1 year and they put 6 years. I think you used 5. They put 6 years worth of donations all in 1 year and carried those forward for whatever reason it was. I can't remember. And then the other thing is, this is a great example of also a side-by-side, because the idea of using up your standard deduction and wasting your standard deduction and versus itemizing every year, that's a complicated concept as well to wrap your brain around, just as a layperson. And so again, showing them side by side, I've showed really helps, where it's like, okay, I get it. You give $25,000 to charity you give $30,000 to charity every year. So you itemize every year. And so they're like, why would I ever standard? It's like, well, let me show you 60 and then a standard, and then 60 and then a standard. They don't always get that unless we show them. So it's another good example. If a software existed that let you show scenarios side by side, that would be a great place to do that.
It would be. And it's always so specific to the client's unique set of circumstances. We could talk about even like the QBI deduction, right? We said earlier that most things are keyed to AGI. They phase in or phase out based on AGI. And it's worth noting, charitable contributions are below the line deductions generally, except for the
QCDs,
the limited above the line deduction we talked about for the past
QCDs
years.
That we talked about.
And QCDs, which aren't deductions, but they don't even add to your income, right?
Right.
But think about the QBI deduction, for instance. There are individuals who are kind of in that phase-in range. And like a married couple, the difference in some cases between being at the low end of the phase out and adding $100,000 of income means adding $50,000, nearly, it's like 49,500, something like that, of federal income, just federal. There's no 49% tax rate, but because of the way the QBI deduction phases out and the rate's actually there, it's kind of like another tax torpedo, which, Roger, you and I have talked about on previous videos. I think we've even got a blog, not a blog, a video up there that people could do as a CE.
That's
right?
Correct, for our premium
subscribers.
Yeah.
There you go. There's a good plug. If you need an hour of CE, go watch the tax torpedo video that Roger put together, all these different concepts, and he let me sit on there and blab for a while about some of them. So the idea here is you could take that person's income down, give $100,000 to charity and reduce federal income taxes by 50. Now, let's imagine they had state income taxes of, let's call it 5. So here's the question to the client. Mr. and Mrs. Smith, you said you're very charitably inclined. You want to give to charity each year. Would you rather this year would you rather give $55,000 to the IRS, or would you like to give $100,000 to charity and the IRS will kick in $55,000 that you actually have to pay $45,000, right? That's the net impact to the client. By giving away $100,000, it costs them $45,000. The IRS and other tax agencies, the states, et cetera, would have paid more towards those charities in some of those cases than the actual client is. Who's going to say no? And remember, it doesn't all have to go to charity in 1 year. Put that into a donor advised fund, and you can leak it out to the charity over 5 years, 10 years. I worked with some clients that were going to do this, where they put $150,000 in and they were going to give about $10,000 a year, but it saved them so much upfront in taxes. It was a no-brainer. They're like, great, we just funded the next 15 years of contributions and the government paid for a third of it. It's really, really powerful stuff. So, again, every situation is different, but that's where, as Roger pointed out, like doing an analysis of, if we do this, this is the net result. Don't just think, look at the tax bracket. That's too simplistic. Even folks that spend all their time buried in the tax code, like myself and many others, cannot just look at a situation and say, well, it's going to save you 20%, because there's too many other permutations.
Yeah, you have to model it.
Losing, which deductions get phased out, what surtaxes are being phased in. All of that creates those funky spikes in marginal rates that we really need to keep an eye on as tax planners. As preparers, who cares? We're recording history. But as planners looking forward, that's the stuff that we need to keep an eye on. All right, Roger, don't ruin that bow. All right.
No, it's good.
I just wrapped it right back up. I took that president, just wrapped it back up. Can we end here?
We totally should. Thank you,
All
Jeff.
right, very good. There we go. Tied it up.
This was fun. Again, Happy New Year, Jeff. And I think we're going to be back talking about some other beginning of year conversations to have with clients, because this is the time to really put some plans in place and save some clients some money.
Indeed. Happy New Year, everyone. We'll see you soon.